Okay, welcome back, everybody. Today is Wednesday. I believe today we're starting chapter 5. We finished chapter 4 Monday, going over some illustrative examples of some entries for the general fund and the special revenue funds. So today we're getting into chapter 5. Let's just take a look here in Moodle to see where we are. So the 10th to the 16th. Yeah, so we finished chapter 4 Monday and beginning chapter 5. Just remember chapter 4 connect assignments, the quiz, all that stuff is due Sunday 11:59 p.m. So just make sure you get those in. And we'll be starting chapter 5 today. So chapter 5 is accounting for other governmental fund types. Obviously, we've already covered the general fund and special revenue. So the three we have left are capital projects, debt service, and permanent. So that's what we're going to be getting into in this chapter. And once again, just like last chapter, I'm going to start with the slides first to kind of go over what the chapter encompasses. And then from that point, then we're going to get into just looking at some journal entries and some illustrative stuff that we've seen from the book. Just like we did in chapter 4 to kind of go through so we see these journal entries and what situations might trigger those type of journal entries, and then ultimately where those entries will be displayed in the financial statements. So some chapter 5 learning objectives. We want to apply the modified accrual basis of accounting and the recording of typical transactions of capital projects, debt service, and permanent funds. We also want to prepare the fund basis financial statements for governmental funds and classify and identify appropriate fund reporting for trust agreements. Okay. So let's just start off with a little review of what capital project, debt service, and permanent funds really are. So we know they use the modified accrual basis of accounting and the current financial resource measurement focus. If an annual budget is used, it may be recorded in the fund, but is not required. What two funds require a budget? Think of what we just went over.
Oh, general
General fund, yep.
and special
And major special revenue funds, right. For which there is a legally adopted budget, right? So those are the only two funds that we have to be concerned about budgets being in. If control of purchase orders is relevant to the fund, we can use it. We have the choice of using encumbrance accounting, and encumbrance accounting usually is done within the capital projects fund. Okay, so when we talk about control of purchase orders, all we're talking about is encumbrance accounting there, right? Because obviously, when we place purchase orders, when we encumber the funds, we're controlling that budget, right, by encumbering the funds so we don't overspend. So that's what they're talking about with control of purchase orders. Generally, they do not report long-term assets or long-term liabilities on fund basis balance sheet. We know this because why? It operates on what type of accounting?
modified,
Right. And with modified accrual, we're only concerned with what?
short-term current.
Short-term current resources, right? So long-term asset purchases are going to be treated as an expenditure within the fund, right? So we know when we have a big purchase, like if we buy a long-term asset, the fund is actually an expenditure, right? And no depreciation is going to be recorded within the fund either. Long-term debt proceeds are going to be treated as other financing sources, right? So within the fund, if we're buying, like we're going to buy a building or something, then we debit the expenditure for the full outlay, and then obviously credit other financing sources, right? Capital projects fund. Let's just look at the actual definition of it. It says capital projects funds account for and report financial resources that are restricted, committed, or assigned to expenditure for capital outlays. Remember that for the special revenue fund, remember GASB gave special attention and guidance to it because for special revenue funds, the financial resources have to either be restricted or committed, right? They can't merely be assigned within a special revenue. But here in the capital projects fund, they can be just assigned, which is so for the other ones as well, right? So obviously the capital projects is restricted, committed, or assigned resources for the expenditure for capital outlays, obviously as the name suggests. However, it would not include those capital additions properly reported in an enterprise fund. And it gives an example here of a water treatment plant. So let's say if like for business, an enterprise fund is used, like it says here, for a water treatment plant. If we build that fund, or I mean not fund, but if we build that water treatment plant, we do not need to use the capital projects fund for it, because it's going to be accounted for within the enterprise fund, right? Because it operates on the accrual basis, so therefore long-term assets and liabilities, all that is fully accounted for in those. So if it's related to something in the enterprise or proprietary type fund, we do not need to use the capital projects fund. Okay. So more on capital project funds. It's used for construction or acquisition of major long-term assets, such as buildings, bridges, sewers, drainages, sidewalks, stuff of that sort, for governmental funds. Proprietary type funds account for construction activities or proprietary activities. They do not require the use of a capital project fund. So we just established that, right? So we know if the enterprise fund is going to do anything for a water plant or a power plant or something, it's going to be accounted for within that fund, right? We don't need a capital projects fund. So sources. It accounts for issuance of bonds and receipt of other financing sources. Because we know sources is only going to be from issuance of bonds and other financing sources transfers in, right? Uses accounts for construction or acquisition expenditures. It does not report the long-term asset in the capital projects fund. It's treated as an expenditure in the fund, right? Because the long-term, the capital assets, where are they reported again?
The government-wide.
Right, is in the government-wide, which statement? The activities or net position? Right, because the net position is like what?
The balance sheet.
Right, and balance sheet is where your fixed assets are reported. So right, government-wide statement of net position. Awesome. So within the fund, it's just an expenditure, right? For the full amount, expenditure, other financing sources, right? And then the long-term implications are within the government-wide statements. So now let's talk about some primary sources of funds for capital projects. So where's the money coming from for this type of a fund? We can issue bonds, right? We all know what issuing a bond is. Grants from other governmental units. So other governmental units can give us grants, so we can have that. Dedicated taxes, so we can actually dedicate certain taxes and earmark them towards capital projects. Transfers from other funds, so the general fund might transfer some money into the capital projects fund, so that's transfers from other funds. And others could be donations, so citizens could make donations for capital projects, or interest earned on funds held. So interest that accrues on funds being held could also be a source of funds for capital projects funds. So all those make sense, right? Just different sources. I think we've all touched a little bit or talked a little bit briefly about each one of these different sources. So no need to really expand on that, right? We get where the money's coming from. So let's just talk about if we actually did issue a bond or issue bonds out of a capital projects fund. So what's that going to look like? So we know long-term bonds are not fund liabilities in governmental type funds because they're liabilities in government-wide statements, right? So let's just assume that the capital projects fund issued $12 million worth of bonds, right, to fund a capital project. So the capital project fund is going to make this entry right here. Obviously, they raised $12 million in bonds, right? So we're going to receive the cash. Cash is an asset, an original debit. It's going up, so we debit cash of $12 million within the fund. And then we credit other financing sources for bond proceeds of $12 million, right? Because it's another financing source. But the long-term debt is going to be on the government-wide, right? So bond proceeds are considered another financing source on the statement of revenues, expenditures, and changes in fund balance. As we can see, we debit cash, credit other financing sources, bond proceeds. Bond proceeds is not a revenue per se, but it is considered a current inflow on the activity statement, right? Okay, number of capital project funds to use. There are some jurisdictions that may require a separate fund for each building project. So if we're building 10 different buildings, they would require 10 different capital projects funds relative to each one of those buildings being constructed. Otherwise, governments may account for all or at least all related construction projects within one single capital projects fund. And if that's the case, the government will use separate accounts for expenditures project 1, expenditures projects 2. So it'll just be more itemized, right? And you'll just have each one of those projects listed within that fund, right? So it's simple. You can either have separate funds or one fund, like a control account, pretty much with subsidiary ledgers. With the control ledger, kind of think of it the same way. You have one capital projects fund, but then you itemize the projects within that fund. Pretty simple, right? So often major projects are going to be financed through bond issues, which really just limits your use to the proceeds to a specific project. So obviously, if those proceeds of the bond issue are going to be tailored or earmarked for that project, the overall goal, even if you keep them within one fund or different capital projects funds, as long as you can decipher or show that those funds are intended for that purpose, then you're good. So it says here, reporting objective, that's the overall reporting objective, is to make sure you can demonstrate that the funds intended to be used on a specific project are traceable to that project. So that's the main thing here, right? Because we're accountable for those bonds. We're accountable. The big thing with government is accountability. So as long as we can trace that money to that specific project, we're good if we use them in one fund. So off of capital projects funds, let's turn and look at some debt service funds now. Debt service funds account for and report financial resources that are once again restricted, committed, or assigned, right? Remember, only special revenue has to be committed or restricted or committed. The other ones can be committed, restricted, or assigned. So that's the case for debt service funds as well. And it's committed, restricted, or assigned to expenditure for principal and interest, right? Because it's a debt service fund, so we're servicing debt, right? We're paying off debt. So obviously, the only two elements that are even relevant to debt is interest and principal, right? It would not include debt service on liabilities properly reported in an enterprise fund for like a water treatment plant, right? Why would this be so? Because they carry their own debt, right? They account for it because it's on the accrual basis. So it's no need to use a debt service fund, right? So I just want to keep pointing that because that's a business type activity, not a governmental type activity, right? So it's on a whole different type of accrual accounting, right? So it's on the full blown accrual, so they're going to account for it. Same as for capital projects. Remember, if it's accounted for within the enterprise fund for the water utility, we don't need to use a capital projects fund. If the debt is relevant to the enterprise fund, we don't need to use a debt service. They'll take care of it themselves. It's a proprietary type. They'll take care of their debt and everything, right? So that's why I just keep on pointing that out, just to make sure that that's clear. So uses of a debt service fund. So you can have three different types of uses: sinking fund and payments on bonds, payments on long-term notes, and payments on capital lease. We know the difference between a capital lease and an operating lease. Obviously, a capital lease, we retain ownership or have a bargain purchase option of that sort. So we actually capitalize the asset on the balance sheet, right? So in that case, we would actually make the payments to the debt service. And we'll talk a little bit more on these other ones moving forward as well. But just on the overview look in, sinking fund, payments on bonds, payment on long-term notes, and on capital leases. So what is the actual purpose of a debt service fund? The debt service fund accumulates resources to pay principal and interest on long-term debts of the overall government. Debt service funds are not used for proprietary fund debts. We just established that. We're just repeating it. Those funds report and service their own long-term debts. So anything proprietary, they got it. Governmental, debt service. While the debt service accumulates money and makes principal and interest payments, bonds payable is not a liability of the fund. This is because the debt service fund uses the modified accrual basis current resource measurement focus. So bonds payable, the long-term, once again, modified accrual. Remember, it's a governmental fund. It's not included in that when it's in the government-wide, right? The bond liability is reported in the government-wide statement of net position. Same thing, right? Pretty simple. If it's governmental fund, if it's anything long-term, we're not concerned with it. It's in the government-wide. If it's current, we are concerned with it. So sources of debt service financing. So where is the money coming from? How is this debt service fund obtaining these funds to operate? So transfers is going to be the first and the most common one. Typically from the general fund, right? So usually the general fund built within the budget, they know that we have payments due on debt, right? That include both principal and interest. So they're going to usually include that, as we said, within the budget to make those recurring transfers to make those timely payments, right, on interest and principal. So that's the typical transfer you'll see is from the general fund. However, you can see some from the capital projects fund. The things that would trigger a transfer from a capital projects fund, premiums or accrued interest at the time of the issuance are often transferred to debt service from the capital project. So what do I mean? Premium. So if there's a premium on a bond, right? So what's that mean if there's a premium? They're actually getting more in, right? But then they amortize it over time, right? If you think of it as when for your for-profit sector, right? Because bonds are either issued at par, discount, or premium, right? So if it's at a premium, then that means it's good, right? We issued it at a premium. That means we're gonna amortize that into and notice that in income over the life of the bond, right? So what that's saying is, and for governmental purposes, if we issue a bond at a premium, that premium, instead of amortizing it over the life like we would in the for-profit, we're just going to throw that premium in the debt service fund, right? Same thing, accrued interest on anything, any accrued interest for our benefit in the capital projects fund, we're going to throw in the debt service fund. And residual equity is going to be transferred from the capital projects fund. So if there's anything left over, residual-wise, equity within that fund, we're going to move it into debt service. Why do you think that we use that debt service as our default fund from moving those transfers out of the capital project like that instead of putting it in the general fund?
Well, I guess that paying off debt is pretty important.
Right, and usually when you incur, like when you actually acquire these fixed assets, right, or capital projects, whether you're buying them completed or you're building them, you usually have to incur debt, right, because they're huge capital projects and the government just doesn't have that type of money just sitting around. So they have to either issue bonds or some type of how we talked about capital projects are going to raise those monies, right? So obviously, if we have anything residual or left over, or anything that's on top of what we originally brought in, we want to put it to where it's servicing it, right? So that's where its best service goes to, is for the debt service. So it just puts the money where it really should go anyways, because usually there's a direct correlation or direct relation between debt and capital projects, because usually it's usually done through the issuance of bonds. So it makes sense. That's why we throw any of the premiums, accrued interest, or residual equity from the capital projects into it. But where does most of the transfers come from for a debt service? The general fund. But it can also come from where?
It come from, well,
capital projects, right. Taxes earmarked for debt service, including special assessments. So obviously, same thing for capital projects. We have maybe some taxes earmarked towards that. We might earmark some taxes for debt service and just say, hey, we're going to use this tax money to pay off debt. And refinancing bond proceeds. So just going through the refinancing process. Okay, let's talk about the modified accrual basis and debt service funds. So we know that the modified accrual basis of accounting applies to all 5 governmental funds, right? Including the debt service fund. But the debt service fund actually recognizes expenditures a little bit different than all of the other 4 funds do. If you recall, we talked about it a little bit before. There's the debt service has the exception to the expenditure recognition under modified accrual basis, because we know under modified accrual, expenditures are usually incurred are usually noticed or recognized
when they're incurred.
When we incur a liability, right? When the liability is incurred. So it says most expenditures are recorded when the liability is incurred. So that holds true for all the governmental funds, right? Except for interest and principal on long-term debt. Remember, interest and principal on long-term debt is recorded in the debt service fund as an expenditure when due, which makes sense because obviously on an installment note or any type of whatever type of debt it is, there's going to be installments due throughout the life of that, most likely, depending on what type of debt you have outstanding. So, main thing here is just remember, the modified accrual, modified accrual is for all governmental funds. Debt service, there's an exception to the rule. It's when the interest and principal is due is when the expenditure is incurred, right? Not when the liability is incurred, which is the other thing. It's when the interest and principal is due, and it's pretty simple if you think about it. When you think about debt, okay, it has due dates. Okay, expenditures is incurred when they are due, right? So not bad, but there is an exception to the exception. Okay, so just follow me for a second. So the exception is what? The first exception is what?
First exception is that it's different from the rest.
Right, it's different from the rest. It's the first exception that the expenditures are recognized in the debt service when they're due. Interest and principal are due, not when the liability is incurred, right? So that's the exception to the rule of modified accrual basis when to recognize the expenditure. But the exception to the exception is when year ends, say December 31st, 2001, right? That's the point in time we're at right now. So it's saying at the end of the year of December 31st, 2001, we have a bond payment due January 1, the very next day of the following year, right? Or within a month. Let's say we're just within January. And the money for the payment was provided in the 2001 budget, right? So the payment's not due till the first month of 2002, but in 2001, it was budgeted for and the money was provided. Then an expenditure and a liability for the upcoming payment may be recorded in fiscal year 2001. So it's an either or. You can put it in 2002 or 2001. And pretty much the key issue is put the expenditure in the year it was budgeted for. So that's the whole catch. That's the exception to the exception. If it's budgeted for in the previous year by law or by rule, you can place it in that year because it was budgeted for, right? So that's the main thing. You want to just keep your budget intact. So if you budget for it in 2001, you probably want to put it in 2001 because it'll keep you more intact, right? But that's the exception. You can make it in that year if it was budgeted. If not, you can still make it in the second, right? So that's the exception to the exception. I doubt I'll test on that just because it is kind of a nuance sort of, and it's something that you might see, you might not see in practice, but it's an either or thing. So it's relevant, but not that relevant. I just wanted to point that out, that there is an exception to the exception. Main thing I want you to be concerned with is there's an exception to when expenditures are noticed or recognized under the modified accrual basis of accounting, and it's in one relative fund. Which fund is there an exception for when expenditures are accounted for?
Debt service.
And why is it different than what the other four governmental funds recognize an expenditure when
the liability is incurred.
Right. The debt service fund recognizes an expenditure when
it's due.
When it's due. Awesome. That's the main difference I want to point out there. So types of debt. For serial bonds, money is transferred in, payments are made, and little or no balances exist at year end, right? Because serial bonds, what's the difference between a serial bond and a term bond? Do you know the difference between the two? So let's just think of the name of them. The names a lot of times can give it away. A serial bond is something where the installments are going to be due in a series of payments, right? So like maybe every year or every other year is going to have a payment. Let's just say annually there's going to be a payment every year. A term bond, the payment's not due till the end of the term of the bond, so at the end of the life. So there'll be one payment at maturity. So that's the difference between the two. So that makes sense for why serial bonds, money's transferred in, payments are made, not a lot of residual equity because it's a series of payments. You know what the payment is. Put it in, put it out, not a lot left over, right? Term bonds, opposite of serial bonds, all the principal on the bond comes due at the end of the term. Let's say perhaps at the end of a 30-year note. Interest may be paid over time in installments, or it could be paid all at once at the very end, right? So those are options. Deferred serial bonds, all that means it's just a serial bond, but the payment is deferred maybe a year, right? So we might have took out some serial bonds, but they're deferred. So we took them out maybe on January 1, year 1. Payment's not due until January 1, year 2, because that's the deferred period. They're deferring it. They're giving us a grace period for like a year until we can start getting some revenue in. So obviously deferred serial bonds, these may not start the payment for more than 1 year after the bonds are used. And like I said, it allows time for property taxes to start rolling in before the due dates are due on that debt. So deferred serial bonds. So what's the difference between a serial bond and a term bond?
Serial bond Just regular.
Right, you have installments like series. You have a series of payments due on it, whereas a term,
Is one.
right. Okay, in term bond and deferred serial bond situations, the debt service fund acts as a sinking fund. Okay, so once again, a sinking fund. Remember we talked about it. Is something. It's just a fund we set up with the trustee, pretty much, right? And you put money in it because to retire the debt or to, you know what I mean, you're just accounting for it. It's like put something in escrow, pretty much, making sure that the money's or encumbering it, however you want to think of it. But that's pretty much what a sinking fund is. You're just earmarking this money to retire that debt or call it back. So in with a term bond or deferred serial bond situation, because the deferred serial bond, remember, you're deferring the payments, right? A term bond, you're deferring the payments, right? So the debt service fund is going to act as a sinking fund. So what do I mean by that? Money is moved into the fund and invested in revenue generating investments, right? So we're going to go ahead and even though we don't have a payment due yet, we're going to go ahead and act as if we do. We're going to put that money in there and invest it in money generating investments, right? So therefore, if we're putting money in and nothing's due yet, it's acting as a trustee or a third party or a sinking fund by holding that money, right, in an investment to one day account for or pay for that debt, right, or extinguish that debt. Present value techniques. Obviously, we know how present values are used. Those charts with time periods and stuff of that sort with the interest rates and amortization tables. We've seen how amortizations are from like a mortgage is amortized with interest and principal payments and stuff. So present value and amortization techniques are used to plan the amount of money that must be invested so that the original money plus revenue earned over time equals required bond principal and interest payments. So pretty much they're just playing with it, right? It's acting as a sinking fund, the debt services for what types of debt?
Bond liability.
Right, but what types of the debt for term and
term and serial
and deferred serial, right? Why is that acting like a sinking fund? Because the payments aren't due yet, right?
Right.
But we're still putting the money in, and then we invest it, and then we use those tables, the amortization and those present value tables, to try to just play with our investments, because those investments are earning money. So we need to see, okay, we put this original money in, it's produced this, and we're amortizing this. That's how the principal and interest works on the payments of the life of the bond. And that's how we kind of see how much we need to put in to be able to service that debt, right? So that's why it's acting as a sinking fund, because you're putting money in it, even though nothing's due, investing it and playing with your investments to see where we are financially on making a payment. That's all that's pretty much saying, right? Long and short. That's the gist of it. Okay, let's go to permanent funds now, right? So we've done capital projects, debt service. Now permanent funds. These should be used to account for and report the resources that are restricted to the extent that only earnings and not principal, so only earnings, not principal, may be used for purposes that support the reporting government's programs, right? So the name tells it all. It's a permanent fund, meaning the principal or the corpus, right? Principal and corpus, same thing. Of whatever is put in has to stay intact for perpetuity, right? So the characteristics of a permanent fund. Contribution of a principal amount from a donor, which is to be invested in perpetuity. Perpetuity is what? Indefinitely, right? So just pretty much forever. Earnings in the fund are designated to a purpose that benefits the government or its citizens. Notice who the benefit is for. The government or its citizens, right? That's why it's in the permanent fund, because it's a governmental fund. So if the purpose is for the government or the citizens' benefit, it's going to be accounted for in that government fund, in the permanent fund, right? So permanent funds are used for what?
Amounts of money where the principal is not to be spent.
Right, it's not expendable, right? You can't spend it. Only the earnings are used for whatever the purpose the donor stipulated for, right? The principal and corpus is held intact for perpetuity. Okay, so now let's talk about trusts, right? So obviously a permanent fund has the characteristics of a trust because people are donating the money, and then they're telling us the principal can't be spent, right? Only the earnings. So we're acting as a trust, as a third party, just holding that money, making sure it's safe and is being used as is specified. So let's just look here. Let's start at the left. We can see there's a purpose of the trust description, and the appropriate fund for it, right? So let's just start here on the left side of this. Purpose of a trust. So it says the trust is to be used to benefit the government or its citizenry, right? So there's our first starting point. We want to know what the purpose is for, right? That's so important because if you look at the first one, it says trust is to be used to benefit the government or its citizenry. Hint, it's going to be accounted for within a governmental fund, right? Now let's look at the bottom part of it. Trust is to benefit individuals, private organizations, or other governments. It's probably going to be not included within a governmental type fund because it's not for the government or its citizenry. So then we're going to probably go to fiduciary funds, right? Because we have governmental, proprietary, and fiduciary. So if we're acting as a trustee. So if it's not for the government or citizenry, it has to be a fiduciary fund, right? And we'll get into that more. So my whole point of going through the purposes first is the purpose is going to tell you what type of fund to use, right? So let's back up. Purpose of trust. Trust is to be used to benefit the government or its citizenry. So what type of fund are we going to put it in?
We're going to put it in permanent fund.
Not yet. It's going to be a governmental fund, right? Because it's going to be, the trust is to be used for the benefit of the government or citizenry. So we know it's going to be a governmental fund, right? Now let's look at the trust description, okay? What the description of the trust is. Let's say it's expendable, meaning that it does not distinguish between earnings and principal, right? Both may be expended for the purpose provided. So if I give you money, say you have your own government, and I give you money and say, hey, Will, here's $100,000. I just want you to use it for scholarships. I don't care if you spend principal or interest. I just want you to use it for scholarships. That's expendable. So therefore, you're going to put it in a special revenue fund, right? Why would it go in special revenue and not permanent?
Because it's not permanent.
It's not permanent, right? But we know it's going in a governmental fund, right? Because it's for the citizenry and the government, right? So let's just, bad example, I said a scholarship. Let's say, something that would, for a park, it's going to be used for a park, but it's expendable. I don't care what you do with principal or interest. Special revenue, because it's a special revenue for that purpose, but it's expendable so we can use it all. So it needs to be accounted for in a special revenue fund because there's no restraints put on it, right? The only restraint is for what the purpose is. There's no restraints on the principal or interest. Now let's say if it's non-expendable, so the trust stipulates that only earnings, not the principal, may be expended for the purpose provided. Now what type of a fund do we put it in? Permanent fund, because it's non-expendable, right? So it has to be permanently held intact. Does it make sense? Only the interest can be used, right? So if it's the purpose of the trust is for the benefit of the citizens or the government, what type of funds do we use?
Government.
Right. What two types is it going to fall between? What two types of government fund? Whether it's expendable or non-expendable. If it's non-expendable, what fund are we going to use?
Permanent.
Because what cannot be spent?
The principal.
Only interest can be, right? If it's expendable and there's no difference between interest and principal, what type of fund are we going to use? Special revenue, because both special revenue and permanent are governmental funds, and it's to benefit the citizens and the government, right? So we know it stays within those funds, right? And the trust description is then to tell us the appropriate fund within the governmental funds, whether it's special revenue or permanent, right? Pretty simple, makes sense. Why? Now let's flip that coin again. Let's move on. We're still as a trustee, right? But now the purpose of the trust is different. If you recall, now it's to benefit individuals, private organizations, or other governments, right? So now we're still acting as a trust, but it's dealing with other individuals, other governments. So now where are we going to put it? In a fiduciary fund, right? So although now let's look at the trust description. Although these are most commonly non-expendable, most of them are going to be non-expendable, right? There's no requirement that they must be so. That's just something to know, okay? There's no requirement that it has to be that way. So the appropriate fund, in this case, if it's to benefit people, other governments or other individual groups, special interest groups and stuff, we're going to use a private purpose trust fund, remember? Because what are the four fiduciary? We have the private purpose trust fund, the pension trust fund. What else do we have? The custodial funds. And my head's went blank now. Let's see if we can figure it out. Private purpose investment trust fund. That's the other one. So obviously it's going to go in the private purpose, not the investment trust fund, because the investment trust fund is when the government is sponsoring it, right, for purposes. So the private purpose trust fund is going to be something that we would use. So it makes sense, right? So if it's to benefit the government or its citizenry, what type of fund are we going to use as a trustee?
Government.
Governmental fund. It's going to fall between what two types?
Special revenue or permanent.
What deciphers between which one it goes to?
Whether the principal is expendable or not.
Right. And then if it is for the benefit of an outside government or a third party or something of that sort, what type of fund are we going to use? Right. And there's really no stipulation whether it's non-expendable or expendable, really. It's up to the donor. And but it usually is non-expendable. And what type are we going to use? A special purpose trust fund, right? Sorry, private purpose trust fund.
One thing.
Uh-huh.
So if it restricts what citizens it benefits at all, would that make it fiduciary instead of general governmental?
Well, no, I think that what it would be if it is still for the citizens of the citizens that the government services, it would still be within governmental. It's still fiduciary, obviously. The only thing that would differ is whatever the purpose of the funds is for. So, like, say if they said only a certain type of citizens, so let's say only African Americans between the age of 20 and 40 are eligible. Let's say I made a scholarship that said, okay, I want my scholarship to benefit those that are African or minorities. And you have to be a minority, and you have to be between the age of 20 and 40, and your income has to be below $15,000 a year. Then all that is you just narrowed down who is eligible for the money to be spent. So then it would still, the only test, it's still going to be for the benefit of the citizenry, right? It's just more of a narrow scope of the citizens. So the only test is still going to be whether it's expendable or non-expendable, which fund you put in. The only difference is there's a restriction. The restriction is a little more tight because it's restricted to that only certain type of demographics. Does it make sense? So it still falls within the scope. You're just getting more picky in details. That's all you're doing. You just keep on, there's more constraint on the funds. It has to be for that. You can't use it on people that aren't minorities or within that age group. Good question though. So that's pretty much your framework. So if it benefits them, no matter what the stipulations are, it's really if it benefits the government or citizens, we know it's governmental. And if it's expendable or non-expendable, is going to determine which type. But from that point, it's just nitpicking the attention to details, right? That's all it is. So we're good on accounting for trusts. We get the difference on if we'd use governmental or if we'd use a fiduciary account. And what type of governmental would use between the classifications or the description of the trust. Okay, now let's just look at a review of the fund financial statements for governmental type funds, because I know we've covered a lot of ground since we've looked at what actual funds financial statements are included. So we know obviously governmental type funds have a balance sheet, right? And remember, the balance sheet must present separate columns for each of the major governmental funds. And remember, what fund is always a major fund? General, right. Every government has to have a general fund, and they cannot have more than one, right? But they have to have a general fund, and general fund is always a major fund, right? So it's always going to have its own column, no matter what. So it must present separate columns for the general fund and each major fund, right? And a single column for non-major funds, right? Because all the non-major funds, if you don't meet that threshold, and what was it? It's the 10 and 5% rule? Yeah. So that's the easiest to remember, 10 and 5, right? Governments may show non-major funds separately if it does not make the reports too cumbersome. So if they choose to make them, out the non-majors and give them their own item or own line, my gosh, I can't talk, column, sorry, then they can do so if it's not too cumbersome. Main thing is general funds always major, and then the other major funds are presented, if you recall how they looked. And we'll get into some examples again later, either Friday or Monday, but probably Monday, looking at some financial statements. The difference between assets and liability is termed fund balance. We know this, right? So difference between assets, liabilities, term fund balance, and we know the fund balance is reported into 5 different categories. We have the non-spendable and then the forspendable. We have the non-spendable, which is if it's prepaids or inventory, right, or the principal or corpus of the permanent fund, right? That's the non-spendable. Then we have the restricted, which is from outside constraints, right? Bond covenants, stuff of that sort. Committed is from the highest level internal of the internal government authority that said it. Assigned, it's encumbered, or they verbally set an intent to spend the funds. And then the unassigned is where only fund that can have a positive unassigned fund balance is what fund? General fund. All other funds, the last level of fund balance for any other funds has to be what? Assigned. Except which one? Remember, special attention is given to one of them. Special revenue, because it has to be restricted or committed, right? Assigned doesn't count. Awesome, good job. So that's the balance sheet. We have the major funds, right? Assets, liabilities, fund balance, and it's broken down into categories, right? So we've got that. We've got that set pretty good. Now remember, there's a statement of revenues, expenditures, not expenses. Statement of revenues, expenditures, and changes in fund balance, right? And this is like our income statement. And obviously the statement is going to have the exact same corresponding major funds, the general fund and other major revenue funds, major governmental funds that was presented on the balance sheet, obviously, right? Because the income statement and the balance sheet go hand in hand. So obviously the statement will have columns for the same general fund, major, and non-major funds appearing in the balance sheet. Now the format is going to be as follows. At the top, it's going to start with revenues, and revenues are by what?
Revenues are by
where are they coming from?
Source.
Source, right? Revenues by source. And then we take away expenditures. They're by function, right? And it's by character is going to describe each of the three different functions, remember? And we'll get into that next. So, but yeah, the expenditures are by function, but the functions are based within three characters, right? And we'll get into that again. So revenues are by source, expenditures by function or character, and we'll get into it. Plus or minus other financing sources or uses. Okay, so what is this line item? What is other financing sources? What are those items?
Transfers.
It could be a transfer, and what else? Remember, there's only two things. It could be a transfer in
or long-term
issuing of incurring debt, right? So that's what this line item deals with. What's uses? Remember, it's only one item. Transfers out. Yep. So that's I'm just doing that just so we know. We know what to expect with revenues. That's property taxes, stuff. That's source by source, right? The money's coming in penalties. Expenditures. Remember, current, capital outlay, or debt is going to be our outlays, and then within that is by function within each of those, right? Then the items to expect to see in here, other financial sources. You just told me what that was. That's transfers in, issuing debt, and then the uses transfers out. You've made that clear to me. Special items, plus or minus special items. What's that stuff we would expect to see in that?
I remember one was the sale of land.
Like sale of fixed assets is considered to be a special item for according to GASB. So that's the most common example of a special item right there. It's kind of, think of this kind of sort of like an extraordinary item that used to be in financial for your for-profit. But the special item in this case is most likely going to be a sale of fixed asset, right? And the main thing, remember, there's a rule there. It's not a normal routine transaction or normal part of the operations of the government, but it still falls within the scope or within the control of the government for that special item, right? So they still control the transaction. It's not out of their control. And it's obviously a special item because we're not in the business of selling fixed assets. The government's not. So that's why it's a special item. And obviously, once we go through all these changes within the period, that's going to give us the change in the fund balance of the year from that activity, right? And then we know we reconcile these by doing the same thing. Kind of remember I said the end of these statements are like the statement of retained earnings for a business. When you start with what the changes in the beginning period and all that stuff, how the format is. It's kind of sort of similar to this. So these changes give us the change in fund balance. Then from there we want to add back the beginning balance, and that obviously gives us the ending fund balance. And this should agree with the balance sheet, obviously, right? Okay, more on the statement of revenues, expenditures, dealing more with expenditures. Obviously, they're displayed by character classification. So within that statement of revenues and expenditures and changes in fund balance, at the very top we'll have the revenues by source, and then we're going to have the expenditures, and then under the expenditures, we'll have current, and then whatever the current, general government, park, safety, whatever, under current. And then we'll have the debt service. Obviously, what are the two elements we're going to see under debt services? What two elements are tied to debt?
Principal and interest.
Right. So that's what we're going to see itemized underneath the debt service, and then capital outlay, whether we spend the money for buildings or anything like that. So that's how you'll see it in the expenditures, but it's by function within each of those characters, right? So that's what we'd expect to see there under the expenditures classification. And like I said, on probably Monday of next week, we'll probably get into looking at some of the some shots of what those financials, both statement of revenues and expenditures and changes of fund balance and balance sheet looks like. So that's all the material I have for today. We are through the material, the slides for chapter 5. So we get the overview of what these other three remaining governmental funds are: the permanent fund, debt service, and capital projects. We get the overview of what's going on, where the money's coming from, all that stuff. So the next two classes on Friday and Monday, we're going to do the same thing we did with the last chapter. We're going to go through, and it's straight from the book. We're going to go through some illustrative examples of what we'd expect to see with journal entries, some normal transactions throughout the cycle of these type of funds, and with some in-depth explanations on why that's happening, and then same thing Monday, we'll do that, and then in Monday looking at some financials that relate to those entries that we make, and then we should be through this chapter 5. So that's kind of where we're going. Just remember, Sunday we have chapter 4 stuff due, I believe, Sunday 11:59, the quiz and homework and stuff, and that's the content for chapter 5. And like I said, now we'll get into some examples on some illustrative cases. Any questions on what we covered today? Pretty straightforward. Makes sense on everything.
Yeah.
Awesome. Good deal. Well, that's all I have for everybody. I thank you for your time, and we will pick up on Friday, still in chapter 5, and just doing some illustrative examples of some journal entries and stuff. So everyone have a good day, and I will see you on Friday.